We have some bad news for Realty Income investors, which started last week on Thursday when Walgreens reported before the market opened. We can see they were down last week 25%. It was a terrible earnings report, and the main thing to take away here for the investors is that essentially Walgreens are looking to cut a lot of their costs, and one of the ways they are looking to do this is by closing down some of their underperforming US stores. Now, when we take a look at what the CEO said, he essentially came out and said how 75% of their stores drive 100% of their profitability. Essentially, what that means is 25% of the stores that are open for Walgreens aren't profitable, and they're going to take a look at those and see how many of those in general they will close. This is an issue because Realty Income, when we do look at their top 20 clients, Walgreens is their second largest client, making up 3.4% of their annualized contractual rent. Now, the bad news doesn't stop there. As we have discussed not too long ago, both Family Dollar as well as Dollar Tree are also looking to close around 1,000 stores. And when we go back to that graph, and we can see in their top 20 clients, both Walgreens and Dollar Tree are sitting there, and collectively they make up 6.5% of Realty Income's rent that they do take from their tenants. Now, that is a bit of bad news, and when we do come and take a look at Realty Income, we can see just last week they were down over 1%. This is a company that does sit in the midpoint of the 52-week range, and year to date they haven't had the greatest return. You would be down around 8%. Now, when we take a look at the analyst rating, we do still see a double buy from Seeking Alpha and Wall Street. We also see a strong buy from Quant, and this is a company that does pay a monthly dividend sitting at nearly 6%. Now, the positive here is that essentially Dollar General, now just as a reminder, they are their number one tenant, making up 3.4% of that total contractual rent, are looking to expand and increase essentially around 800 stores just in 2024, which will hopefully alleviate some of that pain that Realty Income will face with those stores being shut from Walgreens as well as Family Dollar and Dollar Tree. So that is something just to bear in mind. The other thing that we wanted to point out here is that whilst institutional ownership sits at 71%, and we do see over $1 billion worth of sales over the last 12 months, institutions continue to buy a lot of shares of Realty Income, 5.66 over the last 12 months, and just in the more recent quarter, we see a lot more buying than selling, 1.81 billion versus 300 million worth of sales. And again, that is pretty much the theme with these large institutions over the last few years, and this is on both a quarterly basis as well as we can see over the last 12-month period. On top of that, Realty Income still has that dividend safety score of 80, so it does look to be safe. And we can in fact see that just last month it was reaffirmed that that dividend isn't going anywhere, a safe rating suggesting that a dividend cut does look to be unlikely. Now, something else that we also have to consider is that one of the issues that Realty Income does have is that they are facing those high interest rates, and whilst we would like to see some interest cuts this year, we can see that Fed officials now are talking down any chance here of any rate cuts in 2024. Now, the reason why we always talk about interest rate cuts and why we want to see that alleviate some of the pressure that we have seen, not just on Realty Income, but also the industry as a whole, over the last year, we can see this company is down around 12%, and even over the last 5 years, down negative 21%. So what we would like to see with these rate cuts, when we do look at historical data, we can see that real estate investment trusts as a whole do historically outperform after the Fed tightening cycle. So what we can see here is during essentially when their interest rates hike, we note that on the blue, which is the real estate market, it does pretty much marginally underperform equity as a whole. Although when we look afterwards, when the rate cuts are introduced, quarter on quarter over at least the next 4 quarters, we do see the REIT industry outperform. That is the dark blue graph there as well. So we would like to see that happen as soon as possible. That will help some of the pressure that Realty Income are facing. Now we want to quickly update the valuation model for Realty Income, getting to our intrinsic value and our acceptable buy price. Before we do that, we do just want to let you know we have released our latest free weekly article where we run through 10 undervalued companies with phenomenal balance sheets. If you want access to this or any other articles, they are all completely free, and you can click on the pinned comment below to sign up and read straight away. So jumping back into the valuation for Realty Income, as always, we don't look at the Graham's valuation model as it's not relevant for REITs. So we jump into the multiples valuation model where we have the P to AFFO of companies in a similar sector and size, the average P to AFFO, and then we ultimately have the intrinsic value here, which as we can see in today's episode is showing an undervaluation signal. Just bear in mind though, we don't look at any of these models in isolation. We then move on to the dividend discount model, where we have the growth rate over the last few years. Average growth rate at 3.14%. We have gone marginally higher at 3.25%. And what we do note here is that we do get that other undervaluation signal. We then move on to the DCF model with the free cash flow year on year. Realty Income around 20% increase over the period. We've got a lot more conservative at 7 with that discount rate. We got the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt and get to the equity value. Divide by those shares outstanding and we can see a third undervaluation signal. So in today's episode for Realty Income, the intrinsic value is the average of these three models and it arrives at just under $64. Now with a current price of $52, there should be a nice margin of safety, and we always start off with 10% on the channel. We execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for Realty Income, well, it is a buy around $57, and then we keep going till it's near the current trading price. Now in today's episode, we can see it isn't at that 20% margin of safety just yet. It does sit between a 15 to 20% level. Don't forget as well, you can click on the pinned comment below to grab a copy of this model to run your own numbers through, whether it's for Realty Income or others in your portfolio. In terms of Wall Street, they have started to lower down their forecast. Earlier in the year, it was sitting around $63, $64. We do see it now at $60, but they do still see upside of 15%. And as we saw at the beginning, they do consider this a buy for the portfolio. As always, let us know your thoughts in the comments below. Are you seeing any issues with Realty Income over the longer term with these store closures that we have seen from 2 of their top 3 tenants? Or do you believe other companies will come in and take those leases off their hand? As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.